Ladies and gentlemen, because I am very respectful with your time, I thought I would be on time. How about that, eh? Tanner showing up on time, waiting for the rest of his co-hosts. Who could have ever thought about it? And no, they're not backstage. I'm not, I wish I could share my screen of the actual thing that I'm seeing, but no one's back here. Anyway, hopefully everyone's doing well. And let's get started. So, Oh, look who actually shows up.
10 o'clock on the dot.
How you doing?
I thought I was going to be late.
You're not late. You're the first one here. We're already live, though, so.
I am. I can't watch the fourth quarter. I don't want to jinx them, so I walked away.
Oh, yeah? Oh, yeah. Now we're getting the stragglers coming in here. How you doing, Tevis?
Technically late.
Is it the right mic, Steve? You sound quiet. Just double check for me. Tevis, I can't hear you. You're muted.
Oh, hey.
How you doing?
Doing good.
Everyone good? You sound quiet already, Tevis.
I'm fine, man. I just got here.
Good. What have you guys been up to? Steve, I see you're fighting on other people's channels, trying to say that doesn't matter that Palantir is overvalued because, money is money and it doesn't worry about segment. Then you come into my channel and you tell me that SoFi is a bank and it does matter about sector or segment. So I don't want to keep doing this every week, but I mean, give me the fiver on what the heck's going on.
Hold on. I may have to exit and come back in.
Okay. Jeez. I was listening to that the whole, I don't know how long him and Amit were going on for. I'm like, this absolute double-sided. And then Tevis last week going on and on about his spiel about how sentiment matters more than financials or whatever the heck he said. I don't know. I wasn't listening halfway through. Tevis, how are you?
I'm doing okay.
You back? You got good audio?
I don't know. Do I?
Leaving doesn't make your audio better. You can just there's a settings for your audio.
Yes, I'm aware. I did not have my microphone plugged in. I was picking it up off the webcam.
Got it.
I think it still is coming from your webcam. If you want, just stay right here. Don't leave. Press the settings. So it says mute stop cam settings.
I have four.
Live troubleshooting.
Hold on.
I freaking hate this view, by the way.
What?
I hate this view. Anyway, it doesn't matter.
Well, if we get a fourth person, it'll change. Say that again, Steve. No, now I can't hear a thing. You might be muted on your thing. If you're using a Yeti, if it's flashing, then it's muted.
Yeah,
Jeez,
no,
I'm doing
I have
tech
the Yeti, but it's not showing up in the audio.
Let's start the show.
Ladies and gentlemen, welcome to the Fintech Friday show where we talk about SoFi, and then after that we talk about what Steve wants to talk about in that order. First, let's start off with the Anthony Noto JP Morgan Tech Conference. Steve, a tech conference. It's weird that they didn't show up to the bank conference, but they went to the tech conference. What were your guys' initial reactions to that 50 million user goal? I just want to start off big and then we can work our way down. Anthony Noto saying that they can hit 50 million users, or that's their aspirational goal, to hit 50 million users over the next 5 years. I can't hear you, Steve.
In all seriousness, how come it shows Yeti in the speaker but not on the mic?
I think your audio got worse there, Steve.
It shows the Yeti on his speaker but not on the mic. That's
not on the mic.
Dude, plugged in a USB backwards somehow. I don't know how this happens.
Bro, the one time I take the spread on Boston, they're down 40 fucking points.
Why would you take the spread on Boston? What are you doing?
Because I thought that, anyways.
Hey, why do you take the spread on Boston?
is not playing.
I know that, Steve. That's it doesn't matter. I didn't think it would be down 40 freaking points. Yes, I know Tatum is out, Slay.
Guys, can we talk about the actual thing that we all came here? Tevis begged me to do this podcast, and now he's talking about Boston.
I can attest. He did beg you to do this.
Oh
Thank you.
God, I hate both of you. So why are you encouraging this shit, Steve? Can you not have him in the middle, Tanner? Can you put Steve in the middle? There you go. That's much better.
What did you guys think?
Yeah, on the fireside. We got it the first time, Tanner. Hold on, man. All right.
I'm looking at this.
Did he drop off again?
What is going on? What are you guys doing to me? I knew that this podcast was gonna have some bad mojo. Roy wasn't here. It was all gonna fall apart. I don't know what the heck is up with you guys.
It's gonna come back. All right. There you go. Thank you. Fireside. Great fireside. Steve, is your mic working? Let's just check.
No.
I'm getting really annoyed that it's
There
not
you go. You got it. You got it.
No, but it's on the Logitech.
It's on the Logitech.
It's not on the Yeti. It's on the Brio.
Oh, well, maybe you just yelled or something. I don't know.
The Yeti is not even showing up in the mic section. But it's showing up in the speaker section. It's very annoying.
Did you see the JP Morgan Tech Conference, Steve?
Did I see it? No, I did not see it.
Did you read the transcript?
I skimmed the transcript.
What were your thoughts? Did you see the part where he said that they could potentially hit 50 million members in 5 years?
Yeah, I saw one section say 15 million and one section say 50 million.
Bad transcript.
There's no way he said 15 million. Like, let's get this out of our mind right now. It's
he didn't. I'll tell you, he did not say 15 million.
That's what I'm saying.
He definitely did not say 15 because
they're at 11 in 5 years. Want to go to 15? Yeah, 4 million in 5 years. They're aiming for 800K a year, guys.
I mean, look, I think 30 million is reachable. I would love to see 50 million. I think it's ambitious, but I like the spirit.
But it essentially holds up the growth rate that we just saw last quarter for every quarter over the next 5 years. 20 straight quarters of holding up the same growth rate is what we just saw. That'd be hard, especially considering that the last quarter that we just did was a record-breaking amount of new customers. Almost every single quarter will have to be a record-breaking new member add. Is that even possible?
Yes.
You don't think that there will be secular slows or,
You asked if it's possible, not probable.
Is it probable? What about that?
I don't know.
Tevis?
What was the question?
Is 50 million members probable?
Depends on your definition of probable, I guess. It's possible. Look, I think they have to reinvest into their growth, and they have to do that for a while. Like, okay, so you have 20 quarters from now until then? 4 quarters a year times 5 years. And then 40 million members to add, 39, but let's just round up for the sake of math. 2 million members a quarter-ish, right? For the next year, year or so, they're going to be adding, let's just round it up to 1 million for the next 4 quarters. So that's 1 year gone. Then the second year after that, they have to ramp up to 2 rather quickly, which means that the back half of the years, they have to be doing like 3 million or 3.5 or 4 million members a quarter to be able to get there. I wouldn't necessarily say it's probable, but it's definitely possible. I think the more difficult thing is the second part of that sentence or that statement that he said, we basically want to have 3+ products per member, which is like almost a more insane statement to me because they're at like 1.5-ish right now.
Yeah.
And so like, not only do they want to add 40 million members, but they also want to have like on average double their products per member count.
Yeah, more than double. Yeah.
Not great, but it's possible.
This is the
But
way
I
I
do
broke it
think
out.
I do think if they have 50 million members and 150 million products, like they will be very close to being that top 10 financial institution that he talks about.
This is the way I broke it out at 7.52% compounded quarterly, which means we hit 1 million by Q1 of 2026. And then by the way, I did 21 quarters. I didn't even do 20 quarters. I assumed that maybe he was talking by May or something like this. So I included an extra quarter to give him that grace period.
Yeah.
And even with that grace, it's 3.5 million users will have to be added in the last quarter. Dude, I follow all of the fintech companies, all of them. They do not put up these numbers. PayPal does not put up these numbers. Okay. Fully global, 400 million users. They do not add 3.5 million.
Mm-hmm.
Cash App in his prime was doing this. Nubank does this.
So let me sort of tell you what I think is I think they're going to have a super low friction, super low barriers to entry, relay type product, which they can cross sell into everyone. And it's like incredibly easy and or free for you to sign up. Like it's not
Sure.
going to be like, oh, let's do mortgages or brokerage accounts. It's going to be like, hey, check your credit score online type of thing.
Yeah, that would explode. So I did price that in a little bit, but it's also the products per member being 3. So what I assume was a couple things. One, we add on a ton of new products as well. So maybe some customers have like 8 products. Even though he didn't even say that in the
Well, he
in
did
the
say
call.
something that was really interesting, Tanner, which is he said that what they're seeing, the first inklings of SoFi Plus that they're seeing is that once people join SoFi Plus, they suddenly cross buy into their third or fourth products, which they found surprising. And I have the direct quote up here. So they said, quote, the most interesting thing about SoFi Plus that we learned, do you want me to put it up?
Sure, you can.
He said the most interesting thing about SoFi Plus that we learned after launching it, if you throw up my screen, is it is actually triggering adoption of existing members to SoFi Plus, and then they're taking out a third or fourth product, which is kind of shocking, given they were already SoFi members and they weren't taking out those products until they actually signed up for SoFi Plus. So we're very excited about that and a number of other initiatives on smaller things. So essentially saying that, like, okay, SoFi Plus is going to be the catalyst for more cross buying because of those benefits that they're essentially incenting people with.
Yeah. Which makes sense. Honestly, I think 2025 is going to be, if they sum it up to a single objective, will be like the year of SoFi Plus. That'll be the big new product that they push.
Sure. They need more, like, they need more low barrier to entry products that maybe have not been yet introduced. And reading between the lines, that's how I was interpreting that, because there's no other way that they can get to 50 million in that time frame with the existing suite.
Which, products like Cash Coach and Expensar would be massive ones for that. Because I know that, what's the other one that everyone downloads to cancel subscriptions? That other fintech, I don't remember its name. Maybe someone in the chat will remember, but they essentially are just growing mainly off of that subscription thing, which is kind of a little bit of a gimmick. But it's just a really great way to lower customer acquisition costs. And then once you're there, then you can cross-sell them. Rocket Money, thank you.
Well, I do think that, speaking of a gimmick, like 50 million members, if they get that through a product offering that doesn't really do anything for them, but it's super low friction, then that's also going to be kind of not as impactful as people think. Like, it's a sexy number to say on fireside chats, but it's not going to be anything that'll move the needle. Like, Relay is important, but it's only important in the grand scheme of the suite for the data that they collect. So in terms of what moves the needle financially, Relay is at the very, very bottom of the list.
That's fair. I'll agree with you there. but I also think it's probably much easier and it's probably a warmer lead to get a SoFi home loan or a SoFi personal loan for people that have a Relay account than to try to acquire them off platform.
Sure.
And so if they can come up with a product that kind of goes a little viral, that like financial savvy products that go viral, like Rocket Money's subscription canceling service, that could bring on a lot of ancillary gains, I guess. So I don't know. He said 3 to 5 products per user. No, so what he really said was that he wants to aim for 3 products per member at that point in 5 years from now. And he said that means that some people have 5 to 6 products, really loyal customers, and others will have 1 to 2.
Yeah.
That's the exact quote. Well, not exact, but those were the numbers. Let's see. Do we want to talk about the tech platform and potentially the clients?
I have a whole thread on like interesting things set at the fireside. If you want me to throw that up, maybe it'll jog your memory on stuff.
Yeah, but we've all done videos on it. I just want to I don't want to go through just the checklist. We all know the checklist.
Not necessarily, but there's other discussion topics like SoFi Pay, for example, is one that I think would be interesting to chat about. This AI for AML fraud and crypto, I think.
Can I talk on that really quick? The AI thing that he said about underwriting, I disagree with. So maybe
he said we don't need AI for underwriting because it's just formulas and you can plug that all in. That's the part you disagree with?
Yeah. Yeah. I mean, the whole case around what Upstart is trying to do is not so then they can just take factual based data and plug it in and say, oh, this is what AI is telling us. The same thing that 1 + 2 = 3 would equal. Like that's not what they're trying to do. The same way, like if you've ever seen like that statistic that's pretty common, like girls who own horses live longer. Have you ever heard that stat? No?
Oh, Tanner, I have not ever heard that.
Pretty common. It's a pretty common used thing. But the whole reason why girls that own horses live longer has nothing to do with the horse. The reason behind that, and being such a good example, is that if you can afford a horse, you probably have good health insurance.
So this is one of those stupid stats like, oh, did you know 97% of shark attacks happen in shallow water? It's like, yeah, you idiot. That's where the humans are,
Yes, no, but 100%. So the way that Upstart looks at AI in underwriting is not to just take the factual based things into play. It's to take, hey, maybe there's a better way of understanding people will pay us back based on things that we're not quite thinking about. And maybe artificial intelligence can look between the lines and say, these types of people all have this in common and they have the highest chance of paying us back, or they do not have the highest chance of paying us back. And maybe we wouldn't have just seen it in their cash flows. So I actually do disagree with him pretty heavily. I actually thought that, I don't think that his underwriting team would have agreed with it. I could be wrong. But there are definitely ways that you can use artificial intelligence to potentially not just look at the cash flow facts, not just looking at humans like numbers and actually seeing what their behaviors are to potentially see if they're going to pay back.
The whole chat is like talking shit about you. I hope you know this.
Dude, but it is true, though. That's a true stat. But
okay. Cool.
What's it called? So go ahead.
I was just going to go back to the list. AI stuff. Steve's playing World of Warcraft. $100 billion in rejected total addressable market for loan platform business. They want their fee-based revenue to be 60 to 70%. Yeah, SoFi Pay, I think, is interesting to talk about. Tech platform is interesting to talk about. Is it current? Is it not current? Whatever. We can stop wherever you want.
Well, I mean, the pay part was pretty interesting. The SoFi Pay thing.
So maybe explain that. What is it? How would it work? It's like a Zelle competitor, essentially.
Yeah, I mean, it could be, or just any type of form of payment could potentially earn SoFi some money, whether that's ACH or checks or whatever it is, would earn SoFi some money. And potentially, he's brought this up through Galileo and a bunch of different sources as well, that, he really thinks that the market or the segment for payments is much larger than people give it credit for, and they could grow a lot in there. I thought that was interesting. I also want them to really grow out their credit card segment a lot, and he talked about that. Yeah.
So what's the value prop here? From like, how does SoFi make money from this? Just the spread on every transaction, like they make a fraction of a penny, or
yeah. But I think it's just more utilization of the like top of wallet type thing. Like whenever people go to think about sending payments, that it's from their primary bank account, not somewhere else. Because most people who use SoFi, it's not just their only account. They've usually come from some sort of legacy bank or something like this, and still have a lot of their processes through there. So, they want bill pay all through SoFi. They want all those things to, help take a small cut.
Do you think that could be a new product offering that they're going to release at the end of 2020? Because he mentioned that there's more coming on that in 2025 that could lead to an acceleration in their member, because that's an easy product for people to jump on. Yeah,
it could be. I just don't think that any of that is going to change the growth rates or their margins too severely. Like, I think that the member growth is the fastest way to look at how SoFi is going to grow into the future, and probably even to an extent where it's actually not a true statement, because the majority of new members that are coming onto the platform are through financial services rather than lending. So revenue per member actually goes down over time. But it's true. It's true. Not that revenue per individual member on SoFi goes down, but the overall count goes down. It has been for years. But I don't know. I think that they need to show a little bit more evidence that the tech platform's doing great, that loan platform has a lot of capital, and then they just have to keep executing. And for some reason, I don't see it this way, but people like Steven find that not good enough. Right, Steve?
That's right, Tanner.
You don't think that that they're doing the right things over at SoFi?
That's not what I said.
Well, Steve's building a spreadsheet to compare like Pfizer to United Healthcare or something.
I am building a model for something for later.
Yeah, you are.
I'm not playing World of Warcraft. I'm building a model specifically for Tanner.
Oh, it's for this podcast?
Well, maybe for the after hours, but
what company?
Don't worry. Don't you worry about it.
It's Palantir.
No, it's Tanner Corp. We're going to do a little exercise.
Oh, does it have to do with covered calls?
Well, we can do that too, but we're going to do a little exercise on Business 101. Don't you worry.
Business 101.
Right.
That sounds like fun. 11 p.m. Friday night type shit.
Get your coffee ready, because I'm going to bore you to death. How about that?
Oh my God, look at the pouring in of new members getting so excited for the after hours of Business 101.
Anyway, listen, my gripe with SoFi. I love the company. I think they're doing all the right things. I think the growth is phenomenal, but people need to keep in mind it's a lot easier to grow when you're a small, nimble company than when you're an established company for 50 years. that's already gone through the hypergrowth phases. It is a much different situation, even though they're in the same sector. Now, SoFi is still generating, for better or worse, the growth rates are what the growth rates are, but they're still generating those growth rates and that capital from traditional finance. And if they're going to get a tech multiple or a hybrid multiple, they need to shed the financial institution narrative, because we have seen every financial institution trades as very specific multiple on two factors: a low PE and less than double book value. The only one that I'm aware of that has more than double book value other than SoFi is JP Morgan. So,
Yeah, but you're picking and choosing what you call banks.
well, I follow a lot
Amex?
of banks.
Do you follow Amex?
Amex is a credit card company. It's not a bank.
It's definitely a bank.
Sounds
Definitely
like
not
a
a
fintech
bank.
to me.
Well, they definitely have a bank charter. So
Well, do they give home loans?
no,
Do they give
not.
personal loans? Do they have checking accounts? Do they have savings
I'm
accounts?
sure they do give personal loans. I'd
Um,
say they give. I'm sure they give business loans, personal loans.
Well, business bank, oh, a credit card for business is not a business loan.
No, I
Like,
bet you
do they
they can.
actually give business loans? I don't know.
Doesn't matter. Move on.
They're
Well, it
not.
does
They're not a
matter
bank.
because it is a bank.
Not a bank. They don't have checking and savings accounts. They're not a bank. Come on.
Is that
What?
how you define a bank, Steve?
They
Checking and savings
definitely
account?
do.
Amex has checking and savings accounts.
If I'm not misunderstood, Amex definitely has.
I will take it. I'll take my words back, but I mean, I've never heard of Amex having a checking or a banking account.
Well, they collect deposits. I don't know how else they would do it. American Express offers high yield savings accounts.
Really?
Yep, 3.6% right now.
Look at that. Is it money market or savings? So I know they have money markets.
No, high yields. I'm on their website. High yield savings account, FDIC insured by the United States government, 3.6%.
Look at that. Amex is still not a freaking bank, though.
It seems like a bank. Seems like, feels like, looks like.
All right. Well, they're predominantly. How about this? How much of their revenue is credit card versus bank?
A lot, but how much? Oh, buddy. Oh my gosh. And they
Either
also
way-
do personal loans as well.
Either way, Amex,
No
Visa,
more
and
either way.
MasterCard. If Amex, Visa, and MasterCard will never be looked at as banks because everybody puts them in a basket of being a credit card company.
Yes, but that gives them a
Now-
multiple.
Yes, it gives them a multiple. Now, SoFi is being placed in a segment where they're being looked at as a bank. In order for them to shed that, and in order for them to get a higher multiple, which everybody wants, they need to be looked at as a tech company. And I'm not the one that is breaking out the revenue in a certain way. SoFi is. If they reworded everything, maybe it would be different. But right now, the way that they're breaking out their revenue, less than 15% of revenue is tech, and less than 10% of their contribution profit is tech. So if you want to be a tech company, you have to boost that.
Do you guys find it funny that, or strange or interesting that Noto has a reputation for sandbagging in earnings calls, but then he goes on Fireside and he says like top 10 financial institution, top 15 tech company, 50 million users, and like there's some massive cognitive dissonance between those two things, like on the earnings call, and sometimes they're like a week apart. Like on the earnings call, he's like, oh well, the street is saying 3 cents of EPS. We think we'll do 1 cent of EPS, and then a week later he's like 50 million. Like, what do you guys make of
He
that?
doesn't want to be on the record, so they don't put metrics on there that they can't match, so he doesn't miss earnings.
So you think-
Every analyst heard what he said.
Yeah, but it's not on the earnings call.
And to be fair, I always think this has been true with Anthony Noto before as well. Whenever they went public, his 5-year goal was extremely aggressive. And then their 1-year goal has always been pretty conservative. So I think that he not overestimates, but has high hopes for 5 years out.
Do you think he's naturally conservative and he says these things as like headlines for the firesides to stir up excitement and discussion, or do you think he's naturally like optimistic and then he has to restrain himself for the earnings calls?
Yeah, I'm not sure. I think that he thinks that there is a possible road to 50 million members. I don't actually think that he thinks that he can get there. I honestly, I would have preferred if he would have said 40, because then I would think, oh, wow, that's ambitious, but it's possible. 50 million is just like, you're not doing that in the States. I don't know where all these users are going to come from, but that's assuming that all competition stays still. You know, if US banks started to lose a little bit of foothold in credit cards and they offered a 4% cashback credit card, like, you're acting like these companies are not going to say, hey, you know, stay.
Yeah, but I think you're thinking about it very linearly, right? Like, we looked at the revenue growth and we're like, oh my gosh, how are we going to get to some numbers? And then magically the loan platform business appeared and started doing these terrific numbers. I think that he can see the future 3 years or 4 years further than we can see the future for his business. And he knows that there are other products on the horizon that we don't know about yet that can maybe make it very easy for them to scale. International expansion, whatever the case may be, right?
I see a lot of comments recently that talk about World Cup exposure. I don't know if, Tevis, that's you or if that's other people that are bringing that up that is reminding people about that.
Yeah, I don't think it's going to be a huge, like, it's going to be a big deal.
Nothing. I don't think we're not allowed to show the name. I think our brand is covered.
But yeah, but even like, you've had Super Bowls there at SoFi Stadium. You've had like massive, like you had Taylor Swift concerts, and like, okay, great, it's had some positive lift, but it's nothing that like we should be looking forward to it on a multi-year time horizon.
Agreed. I think it's all baked into just their average CAC, you know.
They have to break into some new sports soon, I think. And by soon, I mean like 26. Because like, I wouldn't have said that if it wasn't for his ambitious like comments. And there's two things, right? There's one is, what is the marketing funnel and how do we widen that top funnel of okay, this is the total addressable market of people that we can market to, or we can campaign for. And then the other side of the equation is like, what are we offering them? And what is our product suite that makes it really easy for them to buy from that funnel? And so if I'm thinking about it, they have to expand on both sides. They have to introduce new offerings that are low barriers to entry that allow people to ramp up very quickly when they have zero exposure about SoFi. But then they need new markets like, you know, golf, football and basketball are great, but like you need tennis, you need, you know, all this other stuff, or like even the country singer. Was it a country singer? My point is like they need new avenues to unlock more demographics through different marketing channels to widen that top funnel.
Yeah. It seems like they're getting into country music more than sports right now. Overall, all of it will do well, but I think the best exposure that they can have is word of mouth or something along those lines. So they just need to make products that stand on their own and make people say, oh my gosh, that's so good that, you know what, not only I should have it, but my family and friends should have it as well. But that's hard to recreate things like that. And the companies that have done the absolute best at that, like Cash App, for example, have 57 million monthly actives. I think at the highest they got to 70 or 80 million. And that was a lot longer than 5 years. And boy, oh boy, did they have some of the best tailwinds you could possibly have.
But I think that should be like, and I don't want to pigeonhole our thinking into something like this, but that's how I'm thinking about it, right? Like if they launch a Cash App or Venmo type of application, those things spread like wildfire.
Not anymore, because it's like social media, right? Whenever Friendster and Top 5 and all those apps were coming out, yeah, those spread like wildfire. But then once a company came in and became just a category killer, no social medias explode anymore in terms of getting new user growth like crazy. So the payment ecosystems are created. Like
Right.
there's actually a new one being created right now that connects the ecosystems together, but it's Visa's platform. It'd be hard to fight against the Cash Apps, the Venmos, the PayPals, and the Visas of the world.
Right.
I mean, I could be wrong, but yeah.
Do you think they would change how they define a member?
Yeah, that's
They
interesting.
should.
How would you clarify it, Steve?
Active users, not just users. The same way that Meta used to do daily users and monthly users, because technically I'm a user, I don't log into the app.
Oh, brother. I think that you named the worst example.
Okay. Why? How many people are non-active users that they're counting in their monthly members?
So you have a SoFi account?
I do.
Do you have any money in that account?
Yes.
At all? $1?
Yeah, I have some SoFi stock that I bought on principle to hold it in there, but I haven't logged in years.
That's fine. That's fine. If you have share lending turned on there, they're making money on you.
I have no idea what I have turned on.
Okay, but all I'm saying is, if you have money in your deposit account or stock in their brokerage and you're not touching it, they're making money on you. Facebook cannot say the same. You have to be logged on and be spending time on Facebook in order for them to make money. So the reason why I was anti what Amit said about the monthly actives part and all this stuff is that they don't need you to be active. Facebook needs you to be active.
Yeah, I mean,
if you're paying your loan, you don't need to. You could have it on auto pay. You don't need to show up.
That's different because that has activity on the account.
Well, it's even counterintuitive, right? Like the more active you are, the more you're like not optimized in terms of having your stuff automated for you.
Yeah, but when I mean active, Tevis, if you have a loan and it's deducting every month, but you're not logging in, that's active because there's active activity. You're using a product. You are paying a loan. You don't have to log in. You can set it up, never look at it.
There's some times where it's entire months go by that I don't check my bank account because all of my expenses are automated.
Right, but there's still activity in your account.
Absolutely. But so this is what I'm saying. It depends on how you define activity versus me logging in.
No, activity, not logging in. Actual activity in the account.
Sure.
But it's not like they don't churn accounts at SoFi. You can see that the numbers that they report for ads on accounts, like for example, they said they added, Tevis, do you remember the number? How many accounts did they add last quarter?
800,000?
Sure, it was like 802. Do you know how many they added from last quarter? Like if you take what the number that they reported last quarter and add it to this quarter, how many accounts did they add?
I don't understand the question.
It was 788,000. They did not reach 800,000.
Oh, because it's a deactivated accounts or whatever.
Right. They churn off their customers that are, completely inactive, meaning they passed away, they closed down their accounts, they like for example, SoFi Invest, if you don't show up for a bit, then they will deactivate. So let's not act like they're not using a member as like, oh, someone put in their email address and then never talk to us again. It's like, that's not how they report. And I think a lot of people think they do. But literally just, you want to see their activity, look at their revenue. That's their activity.
Yeah. I also think I want to take this with a grain of salt as well, because 50 million members is a really sexy number because the underlying assumption that people are subconsciously making is that each member is making them money. And it would be an absolutely meaningless number otherwise. I have a bank account that I only use whenever I need to make specific types of money orders or wire transfers, because they have that one feature that my normal bank account doesn't. And so it stays dormant, and maybe once a year I need this specific type of payment, and I just transfer money to this other account, make that payment, then it stays dormant for another year. And so the point is I am not a valuable user to that secondary bank account, right? If Noto really wanted to get to, active users, they can just start making fake accounts and add their users. It's a stupid
which a lot of
example.
banks have been caught doing.
Sure, I think Dave was one of them, or whichever one.
Well, I'm not going to make those claims, but I'm pretty sure, Citi, Bank
One
of
got
America.
fined. Who was the student loan one that got fined because they had like half their accounts were fake? That JP Morgan bought them.
First Republic?
No. JP Morgan bought a student loan platform account, and then they had to like shut down because like half of the stuff was fake. Anyways, or Wells Fargo. Yeah, that sounds like a Wells Fargo thing to do, honestly. But
Wells Fargo has a lot of.
The point is like if you want to spoof the account numbers, like I work for a company and it's a free to play type of game. It doesn't have any email validation. My CEO is thinking about retention. And I'm like, dude, like if we can't determine who's a real user, who's a bot, like I can literally just go to Thailand or Vietnam and get a bot farm. And like you're gonna have the best retention numbers in the world and won't mean jack because they're not real people. So the point is like those are easy numbers, but the only reason it's valuable and the only reason we're talking about it is because of that underlying assumption that like members are in fact equal to revenue. And this is why I say like it's going to be a meaningless conversation if they get like like a SoFi Pay type of product or a Relay equivalent type of product where they make basically nothing off of them. And yeah, they get close to their 50 million, but it doesn't equate nearly enough to what we think it's going to equate to from a member perspective. It's not like it's going to be 50 million and they're all going to be mortgages. It's going to be 50 million and they're all going to be like Relay. And yes, it was Frank. That was the app that got sued.
Which is so funny. Do you guys remember whenever like 2021 was going on? This is actually how the tech platform exploded so fast. Was just all those random fintechs that appeared. Dave and Albert and Acorn. Like there were so many, and I'm naming actually the ones that had survived for the most part, but there were so many that didn't or are still consolidating to this day. It was just crazy how many exploded. Now it's like, okay, you look at the real big winners and you can probably count them like maybe on two hands.
Yeah. So tech platform.
Steve,
yeah, you must have been happy to have heard that. Come on.
I was.
Okay, tell us more.
And what I don't understand is why didn't he say that on the conference call a week before? Because look, not everybody is listening to the fireside chat, but more people are going to be listening to the earnings call, especially since it's being streamed all over the place. I am once again going to go down that road of their communications department needs a complete overhaul, because for Noto not to say that, he obviously knew that information a week before. That's a critical piece of information and would have made me write something differently in the article that I published if I knew that information.
Which piece in particular? The recovered accounts?
Or whatever it is.
10 new deals?
Yeah.
Yeah.
Well, he specifically called out that the revenue would be reflected.
Starting Q1 2026.
Exactly.
Yes. Once again, critical information that we needed on the earnings call when all the analysts were there.
Well, to be fair, if you guys actually go back, he does not say 10 deals are going to supply revenue in Q1 of 2026. He said there's 10 deals that are some are closed, some are close to closing, and some are probable. And then he said that will supply revenue to Q1 of 2026. But some of them might not happen. They might not close all of those.
Yeah, he said they're highly probable, but they haven't signed yet, which is probably why they haven't mentioned it in the earnings call.
Right. And he also said that there were a deal that he absolutely loved in there that he just couldn't say the name of. Which,
he doesn't have to say the name. I'm not critiquing him on disclosing information that's him behind an NDA, but give us some framework around what's going on. To give it on a fireside chat, not the earnings call, come on. That you can't cut me some slack. That is ridiculous.
Yeah, and another part that I thought was interesting too is that if you go back to the actual earnings call, I'm not going to say that this was like a lie or anything like this, but I think they downplayed the severity of the client that they lost in like this Q1. And they said that the reason that they lost 10 million users is that they lost a fairly large client, okay? And it was because they were diversifying their payment providers or the payment processors. Then, which was not public at the time, was Chime's prospectus that came out and said, hey, we were the one that left.
Yeah.
And we're leaving not to diversify, we're leaving it to bring in-house. Oh, and by the way, we are leaving because SoFi acquired Galileo and we didn't want our competitors to have that information. So, boy, oh boy, was that not said on the earnings call? That's the same effect that people worried about with Braintree for PayPal is like, oh, well, actually, maybe Braintree would have grown a lot better if they weren't actually a part of this parent company that companies do not want to deal with. And is that what's happening at the tech platform? That some companies would have dealt with Galileo before, and maybe their growth as a solo company would have done fine, but as a conglomerate under SoFi Group, that they're like, oh, actually, this is, super anti-competitive for us. Is that interesting, or?
I mean, it's a known risk of them as early as having entertained the idea of buying Galileo. Like, it's I don't think it's anything that's surprising. Obviously, they're not going to mention in the earnings call. Like, how do you even bring that up to analysts? I think it goes unsaid. The numbers speak for themselves as to how big that client was.
Yeah, because it wasn't 10 million new ads. Usually they add about 7 million new customers.
Mm-hmm.
So they lost 10. That means they lost probably somewhere around 17 million.
Yeah.
And boy, oh boy, that's a lot of customers. So clearly it was from their largest client. Yeah, by the way, I should clarify. Chime is, at least of the last report that we remember, Chime's their largest client. But some of their large clients might also be coming back.
So do you think that's Current that's coming back?
The one that I actually, Current or Vero, something like that. More, I don't know, probably more likely Current. Yeah. But they all have companies like Current went to Visa DPS. Yeah. Maybe that's the cheaper, less technical version. And Vero went to Marqeta. So sounds more like Current. They said highly visible installed bases. If there are other names on that list, I don't know about them. But yeah.
Yeah, it just sounds like with Galileo, from everything we've heard so far, that we just have to sort of take into account that you're going to have super low growth rates until the first quarter of 2026 and beyond. And so you're kicking the can a little bit in terms of your expectations for the tech platform.
Oh yeah, and by the way, the whole idea of having a client base that is high earner, high net worth, stuff like this. You want 50 million users? There just isn't that many. That's just the full market. So you can't have that 5x growth and keep the level of FICO that we've had or the type of client, which is fine. I'm not actually saying that that's a problem. I'd rather have the largest TAM than be put in a box. But there will be changes to average revenue per user as you scale. And whenever you're at the top going down, which by the way is much easier to do. This is another thing that we don't talk about often. Capital One, who came in to secure really low end of the credit scheme, once they captured that entire market, they wanted to move up market. They had a really hard time doing that. Very, very hard. The companies
are we still talking about the tech platform, or are we talking about lending now?
I'm just talking about overall company growth. Not credit cards. I just mean capturing audiences here. Uh-huh. Where companies like Amex that have tried to work their way down, very easy for them to do. Very easy. Because it's looked at as a prestigious company. So even the lower end bands would love to work with Amex.
I don't see So one of the more interesting things that I heard reiterated in that fireside was that 60 to 70% of their revenue they want to be fee based is their ambition.
Mhm.
They really like the loan platform business and how it's capital light and relatively risk free compared to everything else. And it feels good to make money that it feels like they're just printing money with no real risk to leverage their marketing benefits and their brand positioning.
Yeah, completely.
And so my thought process is like, well, okay, well, if you never originate anything yourself, then FICOs are going to be less and less important. To Steve's point, like this is going to be seen naturally less and less of a bank, because if the predominant bulk of the revenue moves into fee-based revenue from originating on behalf of others, like who cares what your FICOs are? Like, it's a fraction of your total revenue.
Yeah.
Fee-based is great because it reduces risk on the balance sheet because they're not taking on those loans. They're paying to basically find loans for other people. It's great.
It changes the business model altogether.
It's a great business model. I love it.
I'm going to put a little pressure on you again, Steve. Do you think that a company that was at one point doing 25% fee-based goes to 70% fee-based should be priced at the same multiple?
I don't think that the percentage of where the revenue comes from necessarily matters other than where the revenue and profitability is.
I need like a harness that pulls me, like I just float up. You're killing me here, man. How does that not? The reason why banks are priced the way that they are is because their revenue is risky.
Yes.
Palantir has a high multiple because there's no chance that they lose on the contracts that they're selling.
No.
That's not true. Palantir is a high multiple because they have 124% net dollar retention and they're upselling every contract. So if they have a $10 million contract at 124% net dollar retention, that company's spending 12
Yes,
the following year.
That is why they're
And
doing better
they are on an S curve for exponential growth.
But the
Again,
reason why,
without falling into a Palantir rabbit hole, I think the idea is that fee-based revenue and the concept of having that as your business model should naturally command a higher multiple because of how you make your money and how much of a moat that has around it.
If the fee-based revenue increases in percentage and profitability goes up, the multiple should expand quicker than a bank because it is less risky profitability. But profitability still has to expand with it.
when do you think it's not going to expand? Their margins have expanded every single quarter. Where are you seeing that
they're
it's
a
not
young
expanding?
company. Their margins should be expanding.
What?
They're a young company. Their margins should be expanding.
Yes. But doesn't that deserve a multiple?
Deserves a multiple.
You're going to price it at the same as a legacy bank, multiple 100-year-old bank that is,
as growing its net income by more than the revenue that SoFi does.
Dude, come on, man. You gotta base it on percentages, Steve. Like, what the hell
that's see, here's the point, Steve. This is what I didn't mention last time. It drove me nuts whenever I was thinking about it. I'm not asking for SoFi to be valued at 600 billion. Okay. I'm asking for 30 billion here. So is SoFi
okay, but why? Why are you asking for 30 billion?
To make money.
Reverse engineer it for me.
To make money. We
but that's not good enough reason. Reverse engineer.
Want go up. What are you saying? Why?
Because their members are growing at nearly a third. Well, not nearly, it's more than 30, but can probably hold up a more than 30% growth rate for the foreseeable future. That they do have a product differentiation between their competitors, and that's why people are switching. That's market share growth. That has to come from somewhere. It's not that the pie is expanding so fast that SoFi is winning. They're literally their competitors are losing for SoFi to win. And those losers are the companies that you're saying that they should be matched at the same valuation at.
I wouldn't really call JP Morgan a loser.
I would say in the consumer market that they will be.
I don't think
will be is a speculation which cannot be proven. Go by what they're actually doing.
Yeah, I mean, I think that they have something like 60 million users. something like that.
I think from a they've been losing, quote unquote, Tanner, for the last decade, slowly bleeding in terms of their members who have transferred their primary income away from JP Morgan.
Yes.
Guess what? In the
I would
past
consider
decade,
that a
their net
loser.
income
Their
was up
financials are still going up, though.
24 billion
Yeah,
to
because
58
they
billion.
because they win in capital markets. You
So
know,
they
they're
win.
the biggest player in debt markets in the world. I'm not saying that they're a bad stock to buy. I'm saying for the consumer market, which is the only one that SoFi plays in. I'm not comparing them apples to apples. They're not both $600 billion companies. But SoFi is a disruptor in their space, and JP Morgan is not.
Yeah.
JP Morgan is the incumbent, and the customers that are flowing away from JP Morgan are moving to SoFi, and that is not said in reverse. Customers are not leaving SoFi to go to JP Morgan. Right? Right or right, Steve?
Well, I mean, I don't think we're really seeing customers leave SoFi at the moment. They're still growing on a net basis.
I mean, you saw about 20,000 customers leave SoFi this quarter.
Well, I mean,
on a churn, but on a net basis, they're growing.
It was like 14,000 people, and they probably died
You're
or
always going to
went to
have
jail or
people
something.
leave, no matter what the company is. The difference is SoFi is bringing in way more than they are. Why do people say I'm trolling you guys? I'm not trolling the two of you.
It does seem like you're trolling whenever you just talk about pure numbers, because no one is talking about buying those same companies at the same market caps. See, I think that you can talk in absolute dollars whenever you're talking about Palantir to Salesforce, because they have the same market cap and they're sized very differently. But if you're comparing a $600 billion company and talking about their total absolute dollars, it makes no sense. Like whenever you bring up Apple and you're like, Apple makes this much money, but they're also $3 trillion, Steve.
Yeah.
I'm not asking you to buy SoFi for $3 trillion.
This is what I will say to you, okay? And I think you're going to like this. So give me some rope. I think I'm going to shock you with what I'm about to say.
Duh. I've been building a model.
Like, I think you should, thank God you're sitting. You may need to wear a helmet for this one because you may fall out of your seat. How about that?
You should be a YouTuber with that kind of a hook.
Yeah. That's the new thumbnail.
Yeah. What? All right. Take me off the full screen.
He immediately gets nervous.
No, I want to see your faces. I can't see your faces when he does that. So there is yeah, that's fine. But it's still hard for me to freaking see you guys laugh. But there is a company that is well known that is in the finance space. They're not technically a bank, but they're in the finance space, and they have a market cap that exceeds $50 billion. And their revenue is
Hold on a sec.
$3.3 billion. Okay.
Let me check PayPal's revenue real quick.
I think he's talking about Robinhood, but okay.
Not PayPal. PayPal does way more than $3.3 billion.
Is it Robinhood?
Just hold on a sec. Jeez.
Okay, sorry, go on.
Let me lay it out.
Robinhood makes almost less revenue than SoFi.
Let me lay it out for you. So one company does $3.3 billion in revenue on a TTM basis, and their operating income. Well, no, we'll go with straight EBITDA. EBITDA's not fucking listed, really? How's that even possible? So annoying. All right, I guess we're going freaking operating income, $1.26 billion.
No, we can't compare operating income, Steve. It's not apples to apples. The example's shot now. We can't do it anymore.
It's not shot. Next company does $2.77 billion in revenue.
Steve, share your screen so we can see what you're seeing, bro. Just
he's playing a game.
For the companies.
Hide the names, but I can't remember all the numbers.
One is doing $3.3 billion revenue. The other's doing 2.77. One is roughly $10 billion market cap. The other one's over 50. Should the one that's doing not much more revenue be 50 billion?
What are their growth rates?
You want me to do the math?
Yeah, I do. What are they growing?
And obviously SoFi is
growing 50%.
I didn't realize SoFi was a $15 billion company now. So hold on.
Someone says, Tanner looking nervous now. Do you? No, bro. He's going to bring up this thing and be like, did you realize that Enbridge is actually making more money than
freaking no?
Palantir?
It's a very close thing. It's not freaking Enbridge. Like,
Did you know that GM makes as much money as Tesla?
Tanner,
It's going to be something like this.
Speaking of, while he gets that, what did you think of Buffett selling out of New?
Nothing at all. They've been selling it for quarters on quarters, and yeah, I don't have any feelings about it.
Somebody said Sherwin-Williams and just a paint company.
Yeah, we taught Tevis what Sherwin-Williams was live, and he was like, Sherwin-Williams, that sounds like the paint company. We're like, they are, and he's like, yeah, but what do they do? Like, how do they make money? And they're like, paint, and he's like, paint what? How are you making billions of dollars selling paint? He's like,
$100 billion or something market cap.
yeah, it's something like 60 billion.
Sherwin-Williams.
I think it's 60. Last time I checked, it was 60. Here, let me check. 90 billion.
Yeah, Sherwin-Williams, $90 billion, bro. They sell paint. They sell paint for
Benjamin Moore's a big company too.
What is it?
Benjamin Moore's a big company too, but they're owned by Berkshire, I believe.
Paint.
Yeah, another paint company.
Dude, you know how many people repaint their homes?
Bro, it's paint.
Yes, it's paint, but it's still a product that you sell and everybody uses it.
I had a guy come in and quote the house or the part that we wanted done, and I was like, nah, never mind. I'm good. I don't want to go from white to eggshell white for $2,000.
I gotta tell you, my wife wants to paint also, and I'm having somebody come over the weekend to give us an estimate. Big business.
What are we doing here, Steve?
We're over an hour. We're over an hour, so I think Steve's going to explain this to us in the after hours show.
No, we're having fun.
No,
along with what his other thing is that he wanted to show.
Business 101.
Yeah, no, the business 101 thing is going to be good.
I'm actually really curious to hear if Steve is buying United Healthcare here, because like all the investors are buying.
I didn't, but I'm probably going to buy it next week.
Yeah, that's what I
Guys,
thought.
are you guys proud of me? I wrote covered calls.
Yeah.
I am proud of you.
You want to tell them what you wrote them on and your strike price? So then you can become this oracle of bad trades?
I mean, with the news coming out right now, it actually, I think Moody's might actually save my trade here.
I think you're going to be fine.
Yeah, no, I'm fine. And also, I don't think it's going to go too much further than... Anyway, I'm writing NVIDIA May 23rd for $145.
Wow. It had 6 delta, Steve.
Is that seems low?
I'm going to share my screen.
Yeah, it's pretty low.
I finally built it.
Why? Okay, for money mainly. Honestly, I look back at how much money I probably gave up. It was a lot of money. Now, I was just never explained this through time, and honestly, it was like Tevis getting into it that like really changed my mind.
I explained cover calls to you several times. Don't do that.
No, of course you did.
Why do we have Pope Leo in our chat saying hello, my children? Why?
Of course you did. However, there were some comments that you make whenever you get like really confident in something that scares me away from things sometimes. So like when I forget what it was, but there was something where you're like, oh, it's 100% zero risk or something like this. And then I
said you can always roll when you're
wrong. That was the comment, but that isn't 100% true, is it?
No, you can always roll when you get something wrong.
You can't always roll.
Well, you can. You can keep rolling in the money. You may need 5 years to get out from underwater, but if you have time, you can always roll.
Sounds like you've been there, Steve.
I'm currently there right now.
Yeah. I rolled some Tesla today, but I only roll out by a week.
So do you want to share the screen or not? Do you need it bigger?
Sure.
Almost out of storage. Wow, that's a flex.
All right.
How many
Company-
spreadsheets do you have here, bro?
I have a lot of spreadsheets in there. But it's also my freaking email accounts, and I never delete anything. So anyway, Company A has a 15 billion market cap. They did 2.05 billion in revenue in 23, grew at 37%. I named it that because this is going to be, I have a Tanner Corp above this. But anyway, so they grew revenue at 37% in 2024. And the estimates for growth going forward are 16% in 2025. Hold on.
Can you do company C and put Palantir on here?
Dude, hold your horses.
Company C.
These are estimated growth rates.
Hold on.
I don't even understand what I'm looking at. There's some with percentages, and then company B is in dollars.
Yeah, that's.
Oh, you just need to
that's-
percentage it.
Okay. That should be percentage.
You have it right
You
below.
hit insert.
You have it right below, Steve.
How do you usually do that? Is the craziest way to turn that into a percentage.
Literally right beside the dollar
There's
sign.
a percentage button. Bro clicks
There is-
format to do anything. He clicks format to hit bold. You have formulas. You're
Is that not fucking? Did that not change? God damn it. Hold on.
okay. Wait,
Hold on.
we'll
What
bring
the
that
fuck?
down.
Why did that fucking change? When I moved it, it fucking got fucked
Oh
up.
my gosh. You know, I actually have a spreadsheet course.
Just fuck it. Just do it by hand, bro.
I've got a spreadsheet course. You could learn a lot, Steve. We don't teach formatting and stuff like that, but I'll have to put that
Don't
in.
teach formatting.
I didn't realize that people are at like beginner levels. Steve, don't pay attention. Oh, people are now starting to feel bad. Okay. Okay. So, yeah, back to my covered calls real quick. It is a pretty freaking great system. And because tell me if I'm wrong, guys, there is literally zero risk to writing covered calls if they're covered. Right? Like if I have collateral and I'm not using cash, I'm using shares. There's no way for me to lose other than opportunity cost.
Dude, like you're regurgitating the same thing, like almost verbatim that I've told you multiple times.
Yes, but we're
Yes.
talking in front of a 500 person audience that could learn.
Yes. You are correct, Tanner. The risk is honestly what you'll find as you do this a couple of cycles. The risk is not just the opportunity cost. The risk is you panicking and not wanting to let go of your NVIDIA shares and then doing something stupid and buying back
Yes.
more expensive.
So I could lose my shares, but I'm getting paid at the price that is above obviously what I paid for it. So that's I'm not considering that a loss. Like if I had purchased the company at $100 a share and then said, oh, I want to do covered calls for 110, I'm not losing money if they get called away.
Yeah, and I don't understand how taxes are a risk. Like you're gonna have to pay them anyways, dude.
Yeah, they're not going to tax me more than what I made.
Yeah,
that's also not a risk. But yeah.
So yes, you're correct, Tanner. If you're fine leaving your NVIDIA shares at 145, then enjoy those premiums. But the fun part is, like what I did, for example, is I have an entire actually my largest portfolio by size now is my wheeling portfolio, and like I bought NVIDIA at 114. I'm writing covered calls at 145, and if they get called away, then I'll just write cash secured puts at like 120 or 125.
Right.
You know,
Right.
whatever. And so you get paid on both sides of the thing.
So he says you make more holding NVIDIA long term. Well, this is why I'm writing really long. I'm not writing risky ones. Like I wrote 145s for 10 days out. If that hits, it's not going to hit much above where where it's actually at. So I'll just rebuy. But like I know the company very well. There would need to be a China comes back, buys double the amount of what they were buying before. Some type of news that's crazy. Yeah. Some India deal happens. Yeah, something like this. But even if it does, I'm still fine. I'm just going to buy at 145. It's not going to go to 180 tomorrow.
Oh, so you would buy it immediately back at 145? Like you would let the shares get called away and then you'd buy them at 145?
I mean, that was kind of what I was thinking. Is that bad? Is that bad thinking?
Well, if you're going to do that anyways, then just write it lower so you can get more premium.
Yeah. Yeah. And by the way, guys, this is not on my entire portfolio. I'm just learning still.
But like if you're going to buy them back, don't actually buy them. Like just write cash secured puts like really close to the money.
Yeah, yeah.
Something like that.
Yeah, yeah, yeah. But yeah. And learn Greek's fib levels, RSI. I actually was not planning on doing that. Is that crazy?
Yeah, like I know the Greeks. I don't really care about like RSI or fib levels, to be honest with you. I just look at what the delta is, realistically speaking. That's the main one that I look at, but like the other Greeks are important too as you get closer to expiration.
Steve, did you listen to the CoreWeave earnings call?
Some of it.
What do you think about this business? Because I have a feeling you effing hate it.
I actually like it.
Really?
Kind of like it. I'm worried about depreciation of assets, but I kind of like it.
What about their CapEx, their full year guidance for CapEx?
They better be freaking right with how much CapEx they're spending.
Steve,
did you see the guidance for CapEx?
I did.
Do you remember what it was?
It's like 20 billion for next year.
Yep. 20 to 23 billion. They're expecting to make 5 billion.
Yeah, the problem is depreciation on the assets versus how much they're going to grow on the free cash flow on the inverse. I mean, because it's interesting. It's really interesting.
See, okay, before I bring up your spreadsheet, I just want to talk really quickly.
And I had a bad freaking number, which threw the whole thing off. So I'm like, SoFi is going to grow more than that. Like, where am I?
Oh, so one of them is SoFi. Okay, got it. Thanks for ruining that for me.
But I told you that from the beginning. Company A is SoFi. It's 15 billion market cap. Okay. And this is what the expected growth is supposed to be.
Oh, yeah.
Over the next 3 years. Okay. So from 2023 through 2027, over a 4-year period, they're expected to grow their revenue 118%.
Yeah, Wall Street's been bang on this company, so I believe these numbers.
So no, I mean, these are all the growth rates and everything. Company B currently has basically a 54 billion market cap, and they have more growth from 23 through 27, but their revenue is basically going to be the same, and they're going to have a lower growth rate in the future than SoFi is going to have in 2027. Yet their market cap is 4x. You guys love to talk about growth.
Yeah. The reason why I like to talk about growth is because do you have any belief that SoFi is going to grow 15% in 2027?
Yeah, why?
Okay. Because I think that
why are you trying to start shit by doing SoFi Robinhood? Like, why? And I told you it was Robinhood. Why are you trying to start shit, Steve?
No, because it's similar sector. One is looked at as a certain type of company and the other isn't. And it's clear in the multiple.
Right.
Yeah, right now. Like SoFi, as of a couple of quarters ago, did not just double their revenue, but yet the price in the stock went up by double. So what happened during those different times?
Well, I would say one company is overvalued or one company is undervalued. It depends which way you want to look at it. But these two companies should not have that big of a differential between the two by any stretch of the imagination.
Yeah, I mean, it's in my opinion two different businesses. But
Yes, so they're similar. They're not the same, but they're similar.
Robinhood deserves a premium over SoFi because of their growth rates, not what their
Well-
expected growth rates are of 8%. That's such BS. It's going to continue to grow at 30 plus rates. But
Yeah, but I also think SoFi's growth is going to accelerate too with the loan platform business hitting its stride. So like I think SoFi's growth rates are also kind of BS.
no, they're both BS. They're both BS. But I think like, there's not many companies that can grow revenue by 100% year over year, and Robinhood is one of those businesses.
But
So-
even on the 2025 projected, Robinhood's supposed to do 3.6 billion, SoFi's going to be 3.26, and it's that big of a difference.
Well, we're disagreeing on the estimates here, but like their
No,
rule of
if these
40,
estimates come true,
their rule of 40, so expanding year over year growths and then their margins on that growth is 111%. Do you hear what I'm saying, Steve?
I hear what you're saying, Tanner.
Can you name another company? Bring up Block. Block loves to talk about their rule of 40 and how they're underachieving at 32%.
Okay, rule of 40 is a ridiculous thing to go by, but go on.
Why?
It's not a great metric.
No?
I mean,
You
that
don't like growth rates and margins?
I like growth rates, I like margins, but that's one of the things that all the Palantir bulls use to try to justify the valuation. Is rule of 40, rule of 40, rule of 40.
Yeah.
It's also kind of stupid because rule of 40 is predominantly used for SaaS businesses, which are B2B, and you guys are using it for like B2C businesses.
Yeah, so
So you don't have the same like persona at all.
You're not going to have the same margins as SaaS ever.
who cares?
Who
I don't
cares?
understand.
It's like using like let's use some random
You
metric
can
for
call
like,
it a rule of 100. I don't care. 111 is hard to beat by any business.
no, the point being that like you don't use that metric for that type of bit. Like it's like saying, oh well, Tesla's price to earnings ratio, blah blah blah. Like, and nobody realistically who buys Tesla is looking at these types of metrics because they're focused on other things that pertain more to that business. That's a better indicator for that particular business.
So Tanner,
Yeah,
regardless,
I think any company can be looked at by growth and expanding margins. I mean, that's a staple.
yeah, any company can. It's just rule of 40 is not the best thing to look at. Either way, would you say that Robinhood is overvalued or SoFi is undervalued here?
I think they're both undervalued.
So you think Robinhood should be more than a $54 billion company,
Yeah,
and you think that SoFi should be more than 15 billion?
most definitely. I think SoFi is more undervalued than Robinhood.
Well, I mean, if you think Robinhood's undervalued, then I would 100% agree with you on that.
Yeah, I own both of these businesses. I think that they're fast-growing businesses that will take market share in an ever-expanding total addressable market. That's a slam dunk in my portfolio. Great CEOs. Vlad's a killer. They're going after everyone and everything. And the products that they put out are B tier to no one. Like, other than Legend. I think Legend's their only weak product, and it's getting good quick.
It's hard to look at the valuation difference on this and think that one is overvalued versus one is undervalued. I mean, it just seems like such a miles apart in the way the market is looking at these companies.
I think the difference in the 2024 full year growth of 58% versus 28% is a big difference. Forward guidance is forward guidance, but the only real statistic that you have here is the 28% and the 58%, and that's a heck of a difference. That's more than double.
It's a huge difference.
Yeah, and that's the only statistic on here that's a factual stat.
100%. The rest is all consensus estimates.
Yeah.
And I had to triple check SoFi's because I wanted to see what they had in their deck. But I mean, Robinhood's business. Is this what they're guiding for? 3.6 this year?
Bro. Oh, so no, they don't guide, because they're a brokerage and they can't control the market. So the only thing that they guide for is their operating expenses.
Okay.
So it's up to interpretation.
Okay.
But if the market does well, they'll do great. If the market does not do well, they'll underperform. But yeah, I think that the company will grow at like much higher than 22%. I could see them coming out with 40+% growths. Because they're everything. The assets under custody per user is expanding. The user count is expanding. The revenue per user is expanding. The total cost of servicing those clients are going down. Every single metric that you look at for Robinhood is doing great. And now, very much like the Shift 4 story or something like this, now they're going global. They just bought a company in Canada. They could potentially be getting into equities in Canada, Europe, Australia, Singapore.
Do you think SoFi's guidance is sandbagged?
What?
Do you think SoFi's guidance here is sandbagged from the
It's always
analyst
been
perspective?
sandbagged.
Yeah, it's always been sandbagged. So yes, but however, I think that their 2026 EPS, if we can go back to that really quick, was a crock.
High end was 80 cents.
Yeah, but did you hear what he said in the transcript?
No.
He said, "Do you remember Tevis?"
No.
It was a big load of, I didn't like it too much. He said, if we hit 80 cents, it's because growth was really slow. And if we hit 55 cents, that means things went really well and that we needed that money for growth.
Yeah, we reinvested it basically.
Yeah.
That's counterintuitive.
Well, no, not 100%. Not 100%.
Well, not really, because their EPS estimates are low this year because they're reinvesting into growth, so it tracks.
Yeah. Like if they don't spend as much on sales and marketing and they keep all and they throw more to the bottom line. So it's not that they, Steve, take that. Listen, okay? They are going to invest into a market that they know that they can get a return on. If they don't think that the market's there, they're not going to invest in it.
So they're basically saying that the only way their EPS gets to 80% is if they're not allocating capital back into the business.
Yeah. And they're only going to do that if they think it's good.
That means that they don't see any options to go for.
If it's 80 cents. But they said if it's 55 cents.
Again, it's counterintuitive to the business because they're not investing in the business.
Well, I do think that he was setting himself up to look normalized on him underperforming that guidance. Like, hey, we got 55 cents. This is exactly what we wanted because that means it's high growth into the future. I feel like he's already looking for cop-outs for hitting the low end of that range.
Which is also weird why he would voluntarily throw out a 50 million number if that were the case. So I'm not reading into it as much as you are.
50.
Because
I don't think they get to 50. I think they can definitely do 30.
Yeah.
Maybe 35.
Yeah.
50 just seems
impossible.
You got to be doing $2 million a quarter at that point.
Yep.
And they haven't even broke $1 million yet.
Well, I don't know if you saw my spreadsheet that I brought up earlier, but like they essentially need to add 7.5% quarter over quarter growth rates every quarter until the end, which is how much they did last quarter. So they just need to hold up the growth every quarter. Good luck. That'll be so hard, especially as he thinks that members are going to compound faster than revenue. So he said, we want members to grow at 34% year over year. And we want members to grow at 34% year over year. We want revenue to grow in the high 20s. Okay. Where are you going to be able to cycle that back into capital effective CAC? You're essentially saying, okay, we're going to get like operating leverage is going to go down every new member that comes onto our platform. You know, what we should see is that revenue grows faster than members because then every new member is more attached to the business, has more products, brings in more revenue to the business. That's operating leverage. Crickets.
Okay.
We wrapping there?
Yes.
Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Steven, say the last words.
I don't know what you want me to say.
Bye for now.
Yeah, he does, but he doesn't care.